Hi, Jarrad Brown here, Australian expat financial planner based here in Singapore. Thank you for tuning into the video today. Now, we all probably know as Aussie expats that the Australian dollar is incredibly low when we look back at the last few years against most currencies. Now, with the exception of the pound and probably the euro also, against the US dollar, against the Singapore dollar, we are trading at levels now that we haven't seen for the last few years. So as Australian expats, or even as people looking to invest in Australia, move to Australia, or even retire in Australia, what can we and what should we do about the low Aussie dollar? How do we take advantage of this? And how do we factor it in to our future financial plans? So in this video, I'm going to share with you some simple tips, some options, and also some of the pitfalls to be aware of when it comes to taking advantage of the low Aussie dollar. So let's dive right in and let's have a look at some of these options. Now, before we get into the options, I just want to cover off very briefly what actually drives the Australian dollar. A lot of expats, when we move offshore, we all become instantly FX experts and FX traders. But what actually determines the Aussie dollar relative to other currencies? There are a few critical things. First and foremost, it's important to realise that Australia is a price taker, meaning we don't set the prices of most of our imports, exports, and Australia is very much a commodity-based country. So commodity prices are relatively strong. We have strong demand for iron ore, coal, gas, etc., particularly with China. Then that's typically going to lead to a bit of strength in the Australian dollar. The second one is, what are our interest rates doing relative to the other country? So if we look at the United States, for example, we've seen the Federal Reserve rapidly increasing their cash rate at the same time as the RBA in Australia. However, the Federal Reserve is increasing much more aggressively and much faster. So that's why we're seeing a bit of disparity. We're seeing a lot of strength in the US dollar. We're also seeing a bit of a flight to safety in the US dollar as well, which is driving a lot of the strength there. The third critical component is the credit rating, the safety, the credit worthiness of the currency you're investing in. So at the moment, Australia has a very strong credit rating from the ratings agencies, meaning that most institutional investors, most foreign investors, look at Australia as a relatively safe place to hold their cash. So naturally, that's going to drive a bit of strength. But during these periods of uncertainty, particularly when it comes to China's ongoing growth over the short and medium term, naturally we're going to see a bit of weakness in the Aussie dollar and a bit more strength in the US dollar in particular. So let's have a look at, now that we know that the Aussie dollar is relatively low, what are our options to actually take advantage of this if we're living and working abroad, specifically if we're living and working in Singapore, earning and saving Singapore dollars. Now, there are a few critical options when it comes to taking advantage of the low Aussie dollar. Firstly, we have superannuation. Now, as long as you're not working for the Australian government, if you're living and working abroad in Singapore, for example, you are eligible to contribute to your Australian super fund. You can make both concessional or tax deductible and non-concessional or after-tax contributions to your super. Now, whether or not you should, very important to consult your advisor here, consult your financial planner, speak to your tax advisor, and work out what makes the most sense for you. So that's your first option. The second option is considering a term deposit, or in Singapore, they're often called fixed deposits or time deposits. This is holding your cash with a bank or a financial institution in Australia for a fixed period of time. Now, that might be anywhere from 1 month right through to 5 years. We're now starting to see some of these term deposits at rates of between 3 and 4.5%. And that is often on 1 and 2 year money, so i.e. a term deposit for a period of 1 to 2 years. Now, you may not want to lock up your money. There may be residency requirements, i.e. you need to be a resident of Australia to access some of these. So tread with caution, but it could be a good way to take advantage of the low Aussie dollar. Your third option to consider is if you own property in Australia, i.e. an investment property, you may want to consider holding some cash in your offset account. Now, we've done some videos in the past on offsets and we'll post a link in the notes here, but an offset, simply put, allows you to save some money on your interest, meaning that that Aussie dollar or the cash that you're holding in your offset account may be working a lot harder than simply holding it in your everyday savings account. This could be a good way to keep that money liquid, to make sure it's working for you and take advantage of the low Aussie dollar. The fourth option to consider is an Australian share portfolio. Now, this might be managed funds, that might be exchange traded funds, it might be direct equities, direct bonds, government bonds, whatever it may be, but denominated in Australian dollars. Again, it could be a simple way for you to take advantage of the low Australian dollar. Again, make sure you're seeking some advice here around tax residency, around if this could impact you, particularly in future and particularly when it comes to the proposed tax reforms that we'll likely get a further update on later this year. But again, it could be a simple option for you to take advantage of the low Aussie dollar. Now, the fifth and final key option that I'll highlight in this video is you could also consider, rather than the offset account I mentioned earlier, you could consider simply paying down some of your mortgage. Now, specifically, I'm referring to your Aussie mortgage here in Australian dollars. You might decide to transfer some of your cash back from Singapore into your mortgage account, but do be very careful with this one because it can impact the tax deductibility. If you withdraw that money in future, what you withdraw that money for is going to determine whether that portion of the loan is tax deductible or not. This can be very complicated. It can be a bit of a pain in the backside when it comes to your admin. So seek some advice here and work out what is going to make the most sense. Again, when it comes to anything cross-border, make sure you're seeking some advice, speak to your planner and work out what makes the most sense for you. If you have any questions at all about the Aussie dollar, ways to take advantage of it, or your own situation, drop me a note in the comments. Feel free to reach out to me directly. I'd love to hear from you. Thank you very much for tuning in and see you next time.